The first question is from Jilu. His question is this a buyer or a seller market in West London? What do you think the market will be in 5 years' time for this area?
Okay. Ooh, I need my crystal ball for that. So can I just check the question? So the question is, what will the market be like in, was it West London?
Yes, West London. Is it a buyer's or seller's market in West London, and what it will look like in 5 years' time?
Okay, so at the moment in London, it's very volatile. I would suggest that it's static. It's kind of in balance. So there's unlike most other parts of the UK, there's a balance. I think that to answer that question, there are probably two things that I would point you to. One, inflation. Now, London and the sort of greater London market has been hampered by significant demand and a lack of available stock or development for many years. Plus, also the attraction of it being the capital city and it also attracting investment from overseas. What we've found with that, or I've observed with that, is that the affordability of property in London has reached a point at which it can't really grow anymore, because people just simply can't afford it. And what is happening to us now, and we're all seeing it, is that inflation is really starting to take a grip. In fact, it's been doing it for a year, but we just haven't seen it yet, because you have the impact, you have the ingredients, and then you have the cake at the end, if you want to call it a cake. Inflation is really going to bite hard. Now that's going to push up wages, and I don't know whether or not that's going to be across the board, all of the UK, but I would argue it probably will push up wages quite considerably in London. So as wages go up in London, we flip back into properties becoming more relatively affordable compared to average household incomes, and that means that there's a step further that property prices can go. Now, as it stands today, I don't really know where inflation will end. What I do know, and I can tell you reasonably confidently, is that inflation is high and it will continue to grow over certainly the next few months. It's going to keep going up. So to answer the question in terms of, will it stay stable and static? I'm not sure. I think it may become a seller's market. And in terms of the outlook long term for 5 years, I would just point us all to some of the geopolitics that's going on at the moment, as well as the existing problems we've got. So in the system, we've already got the fallout from COVID, Brexit, and all of those sorts of things, plus the rampant inflation in raw materials and logistics, which is now starting to filter through to our everyday lives. Plus, we've also got major problems with Ukraine at the moment, and the discussion, and even as we sit here tonight, there's still discussion over where it goes. If there is conflict and turmoil, that could radically impact the market, and in a way in which I would argue would put more pressure on asset values and more pressure on our government, and certainly the fiscal measures that we've got within the UK, and actually in most of the European and US markets. There'll be pressure to support our economies and possibly make credit even easier. But I don't know I don't fully know that yet. I can't give you a definitive. I just know that it'll have an impact. So with that in mind, 5 years, it's hard to call it over 5 years, but all of the indicators at the moment suggest that certainly within the next year or two, there will be inflation in properties. And if you wait, you may not realize that. And if you go in after the inflation and the growth has happened, you may actually lose out later on. So I think with a 5 year view, you're going to see growth. I would suggest that what's critical is where you enter the market. Do you enter it now, or do you enter it in 3 years time? Within that 5 year cycle, I would argue probably should be thinking about the market now. I'm not qualified to give you financial advice, so I'm not telling you what to do. I'm just telling you what I think the market is going to do, and where I think that there will be an opportunity to ride on the wave of increased demand. Very long-winded answer there. Apologies. Next one will be shorter, I promise.
Thank you, John. What I'll do is I'll hand over to Robin and Suja. They will continue with the questions because I was conscious they were the one who was supposed to host the Q&A. So Robin, if you can unmute and continue with the questions to John, please.
Thank you, Jito. Thank you, John, for the wonderful explanation of your career along with your data and analytics that you have shown on the screen to our lovely audience. And to continue with the Q&A, we have another question from Jets Luke, where he asked about what is the best part of the country to invest if you are not cash heavy. Granted, it's best done at the postcode level, but this question is generally at the town level.
Okay. Best place in the UK, there are several. There are 300 or more, just over 300 postcode regions. So the first part of the postcode area in the UK. There are significant opportunities in what were traditionally low growth, lower house price areas. I don't want to offend anyone who lives in any areas. Frankly, I live in a low house price area. I live in South Wales, where comparatively property is reasonably cheap. So I would be certainly looking at the northwest of England. I would certainly be looking at parts of the Midlands outside of Birmingham, and I would be looking in sort of along the M4 corridor as we go further west. So those sorts of things. What I don't want to do is give everybody a list of postcodes, and I certainly don't want to give a definitive, because frankly you should do the analysis yourself, because if I can tell you postcodes, but I can tell you now, let's pick a place for example. If you bought a property in if you're buying property in Liverpool, if you're buying it near Liverpool Airport, a couple of years ago, I would have been encouraging you to buy 3-bedroom family homes because they were the growth area of the market. When I did the analysis in December, again, I would not be buying those properties. I would be buying 1- and 2-bedroom properties because that's where the market's moved. And that'll change again because these things always go in cycles. When I showed you the rent and sales demand, that it's cyclical. So different property types and different areas have their growth at different points in time. So you've got to constantly move between them. Now, the art for you as an investor is to be able to analyze and understand that in real time. That's why I've created that software, because I want you to be able to say, right, I am now going to invest in, I pick a random area at Nuneaton, and I'm going to buy a particular property type in Nuneaton because that area is about to see a spike in demand. Is seeing a spike in demand. It's going to see a spike in property values. So yeah, that would be my advice here. Coming on my one-day workshop, and I don't mean this as a plug, but I'll teach you how to do that if that's something that is of interest. And you know, I've got, as Jita said, I've had absolutely loads of people who've started doing this simple analysis that takes a few hours to learn, that are just playing in markets no one else is playing in. It's really frustrating when you enter a property market and there's loads of other property investors trying to do exactly the same thing as you. It is far easier to go to a location where no one else is investing, but there is demand. So yeah, I'm sorry I can't fully answer your question and give you a list of postcodes, but yeah, to kind of answer that question, do your analysis in those areas that have traditionally been a sort of lower cost to buy property. There's if I can, I'll just add another thing to that. It's really worthwhile looking at the average income in an area, and you can get that from ONS, and it's updated regularly. There are lots of areas where people's income has really started to increase. Areas where traditionally they've not seen great increases. They're not in London and they're not in the southeast. They are in those northwest areas. So where there's been a spike in income and not a spike or an increase in property values would suggest to me that's an area where property values are likely to increase at a faster rate. So again, you can do that. If you just want something nice and simple, just look at areas where people's income has seen a big increase over the last 6 months or so.
Thank you, John. To add on to that, a second part to that question is, how is it possible that interest on mortgage is going down again against the salary if the value of the property has gone up in the multiples of salary? So
yeah, to answer that, so as a percentage of your disposable income, so let's say, you know, if you, it's because interest rates are so low is the answer. Okay, so but it's never been cheaper to basically get a loan, or which is a mortgage, and service that debt. as a proportion of your average household income. So although the media says house prices are too expensive and unaffordable, they're actually not. They're actually really affordable. Now you can, at 2%, you can have £100,000 mortgage and pay £200 a month, which is, you can't rent anything for that sort of number. So it's exceptionally cheap if you just pay it to service the interest. That is, it's incredibly cheap to do so. The barrier has been for nearly 10, probably more than 10 years now, has been the ability to access that credit. So for those of us that are fortunate enough to be able to pay big deposits, we can make money hand over fist, frankly, and that's why we get a bit of a bad reputation, because the playing field isn't really fair. You think about, a first-time buyer. When I was a first-time buyer, I only needed a 2.5% deposit. Most in the last 10 years, it's been closer to 20% for first-time buyers. I know it's got a little easier lately. So that's the sort of the myth or the misunderstanding of property. In terms of what I pay, or what the average person pays to service their mortgage, is lower as a proportion of their income than at any point in the last 42 years. So that's what I mean by that, is that it's actually not expensive to pay a mortgage. It's just really expensive to get. You need to have a lot of money to get access to that mortgage, which is where the bottleneck is. That's changing. I'm pretty certain that we're going to see changes in that field over the next, certainly 12 months, possibly the next 6 months.
Thanks for that. And Savio is asking, where is the best place in UK to buy houses? What do you think about East Midlands? Which town would you think in East Midlands?
Oh, I'm not. I'd love. I want to answer you. See, and I want. No, I'm not going to answer it. What I'm going to say is, in the East Midlands, there are many locations where there's high growth potential. So there's not just one or two. There are many. There are several. But it really matters what you buy in those areas. It really matters which properties that you buy. Now, I'm not going to give you the answer to that, because part of I'll be honest, my business model is for me to help you to either understand that and I earn income from that, or it's to provide you with a report and I also generate income from that as well. So I can't give it away, much as I'm sure many people would want me to. And also, if I answer that question, I think everyone else will ask me exactly the same question for the areas they're interested in. What I'd ask you to do is just get a hold of my market read and get a hold of my book, and that'll help you an awful lot. Because really, what I tell you, if I tell you tonight where you should invest, in 2 to 3 months' time, it will be out of date. It won't be the best place to invest. So all of us need to constantly measure the market. So I'd prefer to answer your question by saying I'll show you how to find all of the locations where it's good to invest, as opposed to just give you a location, because I might be wrong, and I could be wrong next month when I do my analysis. So yeah, sorry to not be able to answer your question the way I would like.
The next question is, what will be your advice to a prospective new entrant into the property market, especially if the person is not cash rich?
Not cash rich, right? Not cash rich. Certainly buy in an area. Buy in an area where the market is going to work for you. So many people, and I'm going to have a bit of a rant here, I'm sorry. So many people are trained to buy absolute wrecks of properties and spend lots of money and lots of time renovating them so that they can increase its value by more than they put in at the start in terms of a deposit and also in terms of renovation. And that has worked for a long time in the industry. But it doesn't really work when you've just about got enough money for the deposit and you can only afford certain types of properties. So for you, and frankly, for all of us, actually, whether you've got a small amount of money or a large amount of money, you want to make that money work as effectively as you can. Let the market work for you. Right? I am only interested right now of investing in property types and property locations that are going to grow really quickly over the next 12 months and by a lot. So if I can buy into a location that's going to grow 15% this year, and it grows, I don't know, another 8-9% next year, I can in 12 to 18 months, I can then refinance that property and get most of my money back out without doing anything, without spending money on refurbishments. Now, I'm not saying you shouldn't. I think we should refurbish properties. I think it is a good strategy. It's a good thing to do, but it shouldn't be the only part of what we do. So if I was starting out again, if I just had a small enough money to buy a deposit and get started, I would be, more than anything else, I would be focusing on the area that's likely to grow the most, because that's how you're going to really make that money work. When I started out investing in the early 2010s, I had a good salary, I had plenty of cash coming in each month, but I didn't have a lot of savings. So I couldn't afford to just go and start investing, 80, 90, 100,000 pounds. Frankly, I didn't even have a third of that to invest. But I made that money work really hard for me. I made sure that I bought the properties that were likely to spike in value, and that enabled me to turn that money and churn it again and again and again. It wasn't because I was the best refurbishment specialist. It wasn't because I'm the most artistic person. It's not because I know planning and I have this huge knowledge of planning and building regulations. It was simply because I just knew that the area was going to be in demand. So that's what I would advise you. Do your homework, find the locations where there's a big demand and a big spike in requirement for property, and invest, and be bold and confident enough to invest based upon the analysis that you do, not based upon what someone else tells you to do. Because it's a dangerous thing. I could lie to you. I could lie to you all. I could say, you could argue, I could say, let's get everybody to invest in areas where I currently own properties. That'll push my values up. So, if you listen to me and I told you, I could be dishonest. I'd like to think that I'm not, but you don't know me. None of you know me. You only know me on this call. So we've got to be really cautious. Be very cautious of what people advise you to do. Do your homework. Find the area that's got the highest demand that you're comfortable investing in. Make sure the properties there are affordable for you to buy, and buy them. And if you can get some money off in the process of buying, or you can add some value by doing a small renovation and funds allow, that's brilliant. So then you get double the amount of increase. You get double bubble, so to speak. You get the market working for you, and the fact that you're adding value through more traditional means.
Before I read out the next question, I would like to check with any of the audience if they want to directly ask any question to John. I have another question before I ask that, if any of the audience wants to ask directly over the call. Okay. Another question from Jilu again. What do you want to see in the property that you want to buy? Is there a checklist you follow?
Really good question. Yeah, there is actually. Start of this conversation, Gito said, we are looking for passive income. I am looking for the property that's going to be most passive for me. The most important measure for me in my businesses is my time. I want the maximum possible return on the time that I invest. So I don't necessarily like to buy properties that need too much work. I like to buy properties that need a proportionate amount of work for the amount of money that I'm spending. So obviously, if I'm going to be buying a tower block, I expect there's going to be a lot of work. If I'm going to renovate an old barn, I expect there's going to be a lot of work, but there needs to be a good return on that. For me, my favorite stuff is just standard homes, standard 2 and 3 bedroom properties. There's always a demand for it. There's always a market for it, but there is a higher demand at certain times. It isn't stable. So you'll see an area and suddenly there's a big jump in demand. Then it goes quiet for a little while. Then it jumps again, the S curve, the one that I showed you with rent and house prices. So I like to buy 2 and 3 bedroom homes because on a personal level, I love to provide homes to young people and to families that wouldn't otherwise be able to buy and have been let down by the rental market. That's what I'd like to buy. That's what I would encourage people. If they want simple and the best possible return on their time, those are the ones that perform best. For me, in my measures, in terms of how I measure my success and my business's success for property investing, my most successful ones are the simple family homes. And my most difficult ones to make stack, unusually, when you've listened to a lot of what's put out there, are the HMOs, the house shares. They take up a lot of time and a lot of resource, and I don't get as much of a return on my time invested as I do on the 2 and the 3 bedrooms standard homes that I buy. Everybody's strategy is different though, but that's my view.
While Jito, I think you had got a few questions from the other participants who said that they won't be able to join.
Yes, yeah. I'm conscious of time, but I'll throw one away, which is I think quite interesting one. Now there is always this emotion of like you find a house and you get that first kind of love impression that, oh, this is something which I need to buy. This should be part of my portfolio. And a lot of investors fail in that trap. They fall in that trap of this area looks very nice. This part of the postcode looks very nice. What you will advise for someone that they should not burn themselves investing with heavy emotions, which is, I know we can't control our emotions. We are all human, and emotions is one of the human gift. But
Yes.
when it comes to property investing, I know some specific disciplines you will share, that one or two disciplines where anyone can take that away and put that into their own property journey.
Well, first of all, we're all human, and we all have emotions, and we all get excited about things. And I'm not a psychologist, but I'm aware of, and I've read, and people have told me that are far more qualified than I am, that emotional decisions are far more powerful than logical decisions. We're all excited about making money, so we go and invest in property without really thinking about the risks. That's the reason I wrote my book. We all go to a nice leafy area and we think this is going to work really well. And emotionally, we just decide to invest in that area. We go and listen to someone talk about the amazing success they had 2 years ago, converting HMOs in an area, and we go and try and replicate that 2 years later because it sounds lovely and we're very excited about how much money we're going to make. We even go into properties, we can imagine ourselves living in it, and then we get carried away with the specification and the types of things that we do because it's what we would like. It's all the emotions, and they're very powerful emotions. The logical part of your mind works far more slowly, so it's not as quick as your emotions, and it's not as loud, so it doesn't necessarily have the same gravitas. So you've got to give it an opportunity to manifest itself and actually come to the fore. In terms of checklist for property, well, first of all, do your homework. And when I say do your homework, that doesn't involve you phoning up an estate agent asking what they think. That is not homework, nor is it asking an investor that's already been active in an area for a long time. Remember the house I did at the start, qualitative and quantitative? Work out do a very quick analysis. Is the property that you're purchasing a good price? Is it relevant? And also, in the area and the property type that you're buying, is there a big gap between the top end and the bottom end? Because more often than not, we'll be buying at the bottom end and trying to fix it up and make it look a bit nicer. If the gap isn't big, you're not going to make a lot of money, and you're not going to recover more of that money. So I always look for a large range between property values in a given area. That's the logical side of me. And then I look at demand. So I want to see how much stock is turning over in the estate agents, and I want to see whether or not the rents are going up in the area or they're pretty static. Now you can do that if you use any of the portals, Zoopla or Rightmove. You can work that out. They'll give you the very most basic sort of information. So first of all, don't allow the emotion to happen, but then ignore it or calm it down a little bit. Then I would look at whether or not the property is relevant in an area and it's reasonably priced. Then I would do what I've talked about tonight, which is looking at the market at a local level. Is it the right thing to buy? Are the rents on that particular property type in that area in growth, or are they just sort of gone stale, or are they actually in decline? And I would encourage you to learn how to track demand and turnover of stock, because that's a key measure as well. And then you can overlay, is it affordable and the rest. Again, I don't want to go into too much detail, but they're the key basics that I would focus on. And then you can get very emotionally excited at the end when you make a lot of money, or you get your remortgage, or you get your rental income coming in every month. That's when you can really get excited, and you can allow your emotions to run rife, and you can celebrate.
Thank you, John. Thank you. We got Kubena who raised the hand. So Kubena, you can unmute yourself.
Thanks, Jito. John, just a quick one. I just wanted to find out whether you've done any work on the student market, because just want your view on what are the prospects of the student market when it comes to rental. That's one. And then two, will that be a good starting point for someone that's just entering into the property market?
So the student market. Let's pick on the market first. So first of all, the HMO market across the UK is becoming saturated in some places. Right, in fact, the student market. Everybody talks about great areas to invest, bad areas to invest. I live near Swansea. Swansea is the biggest city, nearest large city to me, and everybody talks about how important and how great the Swansea property market is for student rentals, because HMOs are reasonably cheap and there's plenty of them around. But then you get other reports that say it's the worst place possible to invest, and even some lenders won't actually provide finance in some parts of Swansea because it's so saturated. So you got all this stuff going on. I just like to put all that to one side. If you're investing in the student market, you need to very carefully have a very careful and concise understanding of that market. It starts with contacting the university, finding out the number of students that are enrolled for the next academic year, and also the number of students that are enrolled for the current academic year. If that is growing, fabulous. If it is falling, problem. Okay, nobody does this. It's so easy to do. Freedom of information request, you will get the information. Find out what the student numbers look like in those areas where you're investing with students. If the university has got more intake and it's got a strong growth in student numbers, fantastic. Okay, then we can start looking at what's the available stock. So quick and easy, go on Spare Room or a similar website, look at the amount of stock that is available to rent, and look at the amount of stock that is offered for rent, and do a ratio. So if it's 1-to-1, if there's 100 rooms and there's 100 people looking for rooms, fantastic. If you've got 100 rooms and 10 people looking for rooms, not so fantastic. If you've got 10 rooms and 100 people looking for rooms, amazing. That's an area where you should invest. Strange, and I don't want to deviate away from the question, but interestingly, in the HMO market, there's been a lot of talk recently about co-living and sort of professional HMOs, and certainly I own a few of those. But the data suggests now that actually those co-living spaces are in demand away from student areas. So we try and buy existing HMOs or in HMOE areas where there's demand for rooms, and we then try and create co-living professional properties in those locations. And actually what we need to do is look at the surrounding areas. Certainly we take Swansea again, there are a couple of towns near to Swansea where there's massive demand for HMO properties, and nobody's creating them or investing in them. So that's an opportunity, certainly for me and my businesses, that I will be capitalizing on over the next 12 months. Now, the second part of the question is it a good strategy for someone that is starting out? I can't really answer that because I don't know your strategy. So I like to use OGSM, objective, goal, strategy, and measure. I don't know what your objective is, but certainly if you're just taking a bit of a leap of faith and an assumption, if you want cash flow, then yes, HMOs do generate cash flow quickly from one unit. Caveat that with, generally, if you're going to do an HMO and do it properly, you've got to. They are quite pricey to buy. They're very pricey when it comes to renovation as well. You've really got to put the effort in and the money in, and you're not talking about a small 2-bedroom property. Invariably, HMOs are larger, but as a cash flow strategy, I can tell you that it's good. You'll probably already know that it's a good idea, that you can get a lot more off a unit. But I've seen so many people struggle with HMOs because on paper it looks fantastic, and then when it comes to actually renting the rooms out and keeping them occupied, they fall over and fall foul. So whilst on an Excel spreadsheet or on a stacking document, it looks fabulous. The bottom line is, do you rent the rooms or not? And I've sold HMOs because the market shifted and the rooms don't rent anymore. What's been really peculiar about that is I've actually had people queuing up to buy those HMOs off me. And I've asked myself the question, why on earth would you do this? And the answer is because they haven't done their homework. They haven't looked at demand. They haven't looked at the student market. They haven't got the roll number from the university. They haven't done a ratio of people wanting to rent rooms versus people that actually have rooms. So they've just jumped in because it's cheap. So I hope that answers the question. If you want to know more about HMOs, I think I did a little piece on my YouTube channel, Ultimate Landlord, on that with an interview with somebody. I'm afraid I don't have the link to post it now, but I'm sure you'll find it. And if you don't, do contact me drop me a line on Facebook or something like that, and ask and remind me, and I'll see if I can dig it out and send it over to you.
Awesome. Thank you very much.
Thank you, John. Thank you. I think we'll take this as a last. We got Savio. I think he needs to ask you a question. I'm just conscious he's got 20 minutes and we have few slides to cover, but I think Savio, if you want to unmute yourself and ask your question.
Hi, good evening, John.
Hi, Savio.
Thank you for a valuable section. Fantastic, really, and it's a key for somebody entering in the rental business or like a landlord. Like it's very, you covered a vast area. But just want to check that. I presume, I think all the buy-to-let properties are loan to value is around 25%, like normally. Some lenders do for 20%. Yes. In your case, I think one of the property you bought it for 51,000, you renovated 16,000 and some extra cost, and and then you remortgage it, and I think it's showing a loan to value of 15%. Is it still possible?
One of them I did, yeah. You can still get. You can get 85. So it wasn't one of the cheap ones. It's one of the more expensive ones. So I managed to get an 85% LTV, which means
still
15%.
Possible with the lender. Yeah, 85% loan to value.
Yeah, definitely. And they're more expensive. The reason I did it on these is because they were high cash flow. So I actually, I needed. These properties were part of a strategy. So I bought these because I knew I could buy them cheap, and then I could get them revalued at much higher price because I just caught a really good deal on them, and I was entering the market just at the right time. But the cash I generated at 85% was then used to buy 2 other properties. So I used the cash from those. So I leveraged them right up to 85%. So I got an 85% loan to value mortgage because I then wanted to buy some other properties, which I was only going to mortgage up to about 60%. So my portfolio was balanced, and I do that quite a lot. To answer your question, mortgage broker is probably better placed to give you advice than I am on this. However, certainly my own personal experience is it is not difficult to get a 75% mortgage. It's actually not that difficult to get an 80% mortgage. And in some instances, particularly on HMOs and larger properties, getting an 85% mortgage is also possible as well.
It's particularly in any lender like Paragon or something like that.
It changes all the time. I couldn't really tell you which one. I'm trying to think who we had that one with. And I want to say Precise at the time, but I'll probably be wrong. Okay, speak to your mortgage broker if anyone wants to find a mortgage broker. I'm happy to recommend the one that I use, but I'm not going to do that in public forum because it's not fair to all of the other mortgage brokers that are out there.
That's fine, but looking at the data is fair enough because everybody got 25% to buy, and if I can squeeze 15%, I can afford to buy 2 instead of 1. So that's the equation.
I tend to find, and I don't know if this is correct either, but it's just my experience. It tends to be,
it's expensive for a couple of years. If the market did for last 2 years, then it's better to invest in one than better to go in a high interest rate because the returns are very high. But yeah, in a different market, when it's steady or the market crash, I know that then you have to the interest is high, then I know you're liable for liabilities as well.
Well, I wasn't clear actually. In some of these, all of these remortgages, I haven't waited 2 years. I haven't waited for what I would say is you're probably going to struggle to just buy a property unless you use bridge finance, and we're going to get really complicated at that point. But you're probably going to find there's not many mortgage lenders that'll give you 85% to buy a property. But they will give you it when it comes. They will give you them when it comes to remortgaging them. And my strategy with all of my properties is to put my money in and get my money back out as fast as I can. I hate leaving money in a property because it means I can't buy another property and I can't create another home for somebody that would really benefit from it. So quite often I will go in at 75%. So I'll have a 25% deposit. Now you don't all need to do this. But this is what I do. And then I will remortgage back out later. And sometimes I will remortgage back out at 75% when the property is increased in value. And that's, I think, one of my, this one was a 75% on the way back out. And I didn't pull as much money out. I left a lot more money in. and some I don't. But I always remortgage my properties. Once I bought them, I'm always aiming to get my money back out within the first 9 months, ideally within the first 6 months. And there are lenders out there that will have a no early repayment penalty and they won't apply the 6-month rule. I'm not qualified and I don't know how that changes in the market every single day. That's where your mortgage broker comes in. But tell them your strategy. Tell them, look, I want to buy this and I want to add some value to it. I want to get it revalued. I want to get my money back out on another mortgage within 6 months. And your mortgage broker should be able to assist you with that. Certainly mine does. Because even if you've got hundreds of properties, you still run out of money. Yeah, you can't just keep putting 25% deposit down every time. So yeah, I'd encourage you to speak to a mortgage broker on that. But I'm quite, to answer the question, I'm pretty certain that there's products out there that are 80% loan to value, and certainly in my experience, I've accessed 85% loan to value as well, and that's constantly changing.
Yeah, thank you, John, and thank you, Jito, for inviting me for the valuable session. Thank you, Jito. Yeah, thank you, John. Yeah, thank you.
Thank you very much. Thank you for the question.
Thank you. Cheers. Bye.
Thank you, John. Thank you. So, John, like we got 15 minutes left. There are so many more questions, but I'm just conscious. Yeah, so people have really kind of got into the data side of it now. Yeah. So once again, John, first of all, from your busy schedule, you took time for Project Possible platform. You took your time to come be with us and share your knowledge, experience, and take this all questions. Normally, I know in your sessions you don't take questions because you have so much to give. But really appreciate that you have almost given 45 minutes of a Q&A session. So really appreciate. And on behalf of the entire core team of Project Possible and all our audiences and all those people who are going to kind of watch this podcast and so, we give you a kind of a humble and kind of the biggest thank you we can at this platform. But we want to continue this relationship and continue to work with you and your team. And I'm sure a lot of Project Possible kind of community will benefit from your collaboration going forward. Because with your collaboration, it's like a guiding light for any property investor, especially who are starting off. Because in property, if you burn once, then it is really painful to recover from it and then continue. However experienced it is. I have met property investors who have a portfolio of 100, 200 portfolio, and then they've got burned with one. That's it. And it's very important. So relying on data and insight and research is so important in today's world. As you started off with by that sentence, that it's more important than in the last 40 years. And there are so many things can go wrong. So it's very important that we all rely on that insight. And being by profession an insight manager, I can see your passion, what you have shared with us. So we are very humbled to have you on this platform. Thank you, John.
Very grateful. Thank you for that. And thank you everyone for giving me your time this evening and listening to me. I'm very grateful as well. So thank you. And thank you, Jito, as well, for giving me the platform. Very much appreciate it.